I'm going to assume that it was relatively business as usual until the beginning of this year, call it sometime between January and March. And then all hell broke loose basically in markets, right? And everything from kind of credit markets seizing up to public equities dropping and then exploding up in value. You saw commodities kind of all over the place. Maybe talk a little bit just in with the hindsight benefit now of like where we sit today in September of 2020, what's transpired from your position up till now? And then we could talk about kind of moving forward. But these are some of the craziest markets that many people have kind of navigated. And so, kind of, how have you navigated those markets and kind of what's changed from an asset allocation standpoint for the clients that you guys serve?
So there's so much in that question. We could spend the entire time together talking about that one. Let me start, and then you guide me where you want me to go from there. So, in thinking about kind of into the end of 2019 and rolling the calendar forward to 2020, we were actually feeling pretty good. Despite how far the market had moved in the back half of last year, we were feeling pretty good about positioning. We were starting to see some green shoots in terms of a cyclical acceleration after a really kind of slow and tough, if not choppy, slog over the course of 2019. And I'll just throw this out for fun. Like every year, I try to assign a musical reference or a song of the year for the coming year. And so this is going to sound insane now looking back on it, but there's still some truth to it. The song we picked for this year was the Grateful Dead's Truckin'. And so the idea really was that given all of what has gone on, the long, strange trip that was the prior business cycle, investors really shouldn't get tripped up by some of the challenges that were in front of us, that we thought the cycle still had legs and that it could keep going. And so we did start to see in January and February, pre-COVID, that meaningful acceleration start to take hold. So we were feeling pretty good about positioning and didn't make a ton of changes early in the year. We did over the last like 18 months, like leading up to that, start to make some changes at the margin because we felt like the cycle was getting pretty long in the tooth. And we thought the volatility was going to continue to pick up, where there were a lot of headline risks, macro challenges around trade policy and that sort of thing. And so to try and get clients still comfortable with being fully invested, not overweight, but comfortably fully invested according to their investment policy statements and their strategic asset allocation, we started to incorporate some asset classes that had a little bit more ballast in them. So as a good example, we incorporated global infrastructure, and that's a nice way to kind of straddle the U.S. and international markets, stay in equities, but dial back some of the volatility exposure. And so that was kind of a key story for 2019, even though the market finally got its act together towards the end of the year. Of course, COVID hit. That was not in our crystal ball, sadly. It was not in our 2020 outlook by any means. And so the world shifted pretty dramatically. The good news or bad news about it is I think there were only about 3 days in the midst of the record-breaking downdraft and then rally that anybody really had a shot at repositioning portfolios in a significant way. And so believe it or not, we stayed fully invested and rode right through it. Even though volatility as measured by the VIX hit, 80 plus, like all-time records. And so our view on it was really one that the markets over time have wrestled with pandemics. This is not a new phenomenon, dealing with pandemics, though the magnitude of this one has obviously been really significant. What was new is that we proactively, or maybe reactively, depending on how you want to look at it, shut down the global economy. Those two things were never synced up before. And so that was really the key difference. This wasn't an asset bubble bursting or the kind of a typical or usual end to a cycle. We shut this thing down. And so in our view, we didn't think that there was a need to really pull the ripcord and de-risk. We've seen these things sadly play out before. The financial crisis is a good training ground for how big markets can whipsaw around events like this. And so we felt, given the strength coming into 2020, the fact that this was artificially induced, that is, we shut down the global economy in response to it, that it would be kind of a bridging the gap shorter term type of event, and that maybe things wouldn't normalize overnight, but that we would start to get back to a recovery in relatively shorter. So we felt good about kind of staying the course. Of course, what has changed since then is it wasn't just a few short weeks. It's hard to believe that we're still all very much kind of working remotely, and I think something like half of GDP tied to states today is still in some form of pausing or readjusting their reopening plan. So we're definitely not back to normal, and I would say we're definitely not back to a new normal. But some lessons that we have learned really so far and in this short period of time is that there's a real distinction between the haves and have-nots, Wall Street versus Main Street. So we've started to see an even bigger way than pre-COVID, this really bifurcated market and economic environment start to assert itself here. And you can see it in the day-to-day movement in the public equity markets. Depending on what the news flow is suggesting on any given day, it's the stay-at-home trade, everything you need when you're hunkered down, or it's the go-outside trade. And it's just this churning that continues to go on. But net, we think a really significant, perhaps structural difference as a function of what has gone on since COVID began is really that the big are likely to get bigger and that the growthy are likely to get growthier. And so what does that mean? It means that, regardless of how long this environment persists, we think that the bigger names, the mega cap tech in particular, so the Qs, which have garnered a ton of headlines lately, are really likely to use this environment to their advantage. You can already see it in the companies that have fortress-like balance sheets, that are paying dividends, that have the potential to grow their dividends. You can see it in the M&A market. There's leverage that's occurring here for those business models that have been able to kind of manage fairly swimmingly, technical term, swimmingly through this environment, and yet the value side of the equation continues to struggle in a meaningful way. And so our view over the course of the summer shifted to be, wait a minute, this is not just a very short-term phenomenon. We think there's something to this. And so we did tactically shift away from small and mid-cap value in domestic markets specifically because of that. And when we think about small and mid-value, we're really looking at exposures that span the energy sector, the financial sector, REITs, and even parts of consumer discretionary. And we can talk about all the kind of thesis and rationale behind that, but even where we sit today, even how far the market has rallied, it's really hard to point to a significant positive catalyst to really get any of those sectors, and especially the ones that are sitting in the smaller cap part of the spectrum, going again. We think that all the stimulus that has come into the system has definitely saved the day. Chair Powell, with his superhero cape on, absolutely changed the game, critical. But it also has masked, at least on the fiscal side, it has also masked a lot of the underlying stresses that are only now starting to kind of show up in the system. And so we've seen a few bankruptcies, we've seen some defaults, but we really haven't seen a meaningful default cycle start up yet. And I think the longer this goes on, and the longer we are not able to get some form of fiscal stimulus going, the tougher slog it's going to be. So we may need to do more there from a positioning standpoint, but believe it or not, we are very comfortable with our exposure in the NASDAQ 100 right now. It's not, let me just clarify, that is not our only exposure, but making that tactical shift there, even where valuations are sitting and even how far that part of the market has rallied, we think there's a lot of opportunity left there.